Namaskar. This is the first monetary policy statement of the current financial year 2022-23. I welcome everyone to this statement, which will be followed subsequently at 12 o'clock by the usual press conference. 2 years ago, in March 2020, we began a journey to fight the onslaught of COVID-19 on our economy with courage and determination. During the period thereafter, the Reserve Bank has successfully navigated its course through turbulent waters. While the pandemic has scarred our psyche and tested our resilience, we have responded with bold, unconventional, and resolute measures to stabilize the economy through the 3 waves of the pandemic. As the situation normalized, we have taken measures towards rebalancing liquidity conditions while ensuring that our actions are nimble and proactive but well-timed. Now, 2 years later, as we were emerging out of the pandemic situation, the global economy has seen tectonic shifts beginning 24th February, with commencement of the war in Europe, followed by sanctions and escalating geopolitical tensions. We are confronted with new but humongous challenges: shortages in key commodities, fractures in international financial architecture, and fears of deglobalization. Extreme volatility characterizes commodity and financial markets. While the pandemic quickly morphed from a health crisis to one of life and livelihood, the conflict in Europe has the potential to derail the global economy. Caught in the cross-current of multiple headwinds, our approach needs to be cautious but proactive in mitigating the adverse impact on India's growth, inflation, and financial conditions. We are, however, reassured by the strong buffers that we have built over the past few years, including large foreign exchange reserves, significant improvement in external indicators, and substantial strengthening of the financial sector, all of which would help us to weather this storm. Please note that I'm emphasizing on 3 different aspects which places us in a position that would enable us to deal with the emerging crisis and the challenges. The first, significant improvement in the external sector. The second, foreign exchange reserves, which are at very comfortable levels. And third, substantial strengthening of the financial sector. I will be dwelling upon this in detail in the later part of my statement. Once again, we in the Reserve Bank stand resolute and in readiness to defend the economy and navigate out of the current storm. Let me now turn to the decisions and deliberations of the Monetary Policy Committee. Against this backdrop, the Monetary Policy Committee, that is MPC, met on 6th, 7th and 8th April, and based on an assessment of the macroeconomic situation and the outlook, voted unanimously to keep the policy repo rate unchanged at 4%. The MPC also decided unanimously to remain accommodative while focusing on withdrawal of accommodation to ensure that inflation remains within the target going forward while supporting growth. The marginal standing facility, that is MSF rate and bank rate, remain unchanged at 4.25%. Further, it has been decided by the Reserve Bank to restore the width of the liquidity adjustment facilities, that is the LAF, L-A-F, that is the LAF corridor, to 50 basis points, 50 to 50 basis points, the position that prevailed before the pandemic. The floor of the corridor will now be provided by the newly instituted Standing Deposit Facility, SDF, which will be placed 25 basis points below the repo rate, that is at 3.75%. I shall explain the details in this regard in the later part of my statement. Let me first dwell upon the MPC's rationale for its decision on the policy rate and the stance. Since the MPC's last meeting in early February 2022, the expected positive benefits from the ebbing of the Omicron wave have significantly changed. Omicron wave have been offset by the sharp escalation in geopolitical tensions. Let me just read this sentence again. Since the MPC's last meeting in February 2022, the expected positive effects of the Omicron wave, expected positive benefits from the ebbing of the Omicron wave have been offset by sharp escalation in geopolitical tensions. This has significantly changed the external and domestic landscape. Concerns over protracted supply disruptions have rattled global commodity and financial markets. Given the significant share of the two economies engaged in the war in global production and exports of key commodities like oil and natural gas, wheat and corn, palladium, aluminium and nickel, edible oil and fertilizers. Now these are, I have listed out the points which basically are at the root of the concerns over the protracted supply disruptions which are causing all this turbulence and in all these areas. So concerns over protracted supply disruptions have rattled commodity and financial markets. Given the significant share of the two economies engaged in war in global production and exports of key commodities like oil and natural gas, wheat and corn, palladium, aluminium and nickel, edible.
So the RBI playing it safe once again and maintaining status quo. Let me go across to my colleague Hina Gambhir for more on this. Hina, so just sum up the main key points, key takeaways from the RBI briefing so far. But essentially the RBI, though the pandemic seems to be in a sense ebbing, but the RBI is still playing it safe and keeping key rates unchanged.
Well, that's right. RBI is keeping it safe for the moment because of the existing geopolitical situation that we have, which is leading to crude prices going up, which is definitely not a very good news for a country like India, which relies heavily on crude imports. Now, RBI, as most economists had expected, has kept the key interest rates absolutely unchanged, which means that, after today's policy decision, our EMIs are not going to see any kind of a change. Neither they will get expensive nor they'll get, cheaper from the current level. So that is one key takeaway for people who have home loans at this point in time. And as we are speaking, Tanima, the RBI governor is still addressing that crucial press conference. As of now, one important point that he has raised is about the issue of repo rate, the reverse repo rate that has left unchanged. This is the 11th time in a row that we have seen RBI keeping the policy rates on hold, looking the current situation. Now, some economists did expect the RBI to increase the repo rate, but that did not happen because of the existing geopolitical situation. Now, RBI governor has also raised concerns over the crude prices and the impact it is beginning to have on our inflation levels. So I'm just waiting for those numbers to come out. RBI governor is expected to give us the data as to what is going to be RBI's target for inflation for the current financial year, because the retail inflation that RBI looks at, that level has already been breached in the last financial year, and RBI's target this year is expected to be slightly higher. We'll also look forward to what the RBI has to say on this year's growth target, because yesterday, just ahead of this RBI policy review, we had a statement coming in from Ministry of Finance wherein the government in a way sounded a cautionary note and suggested that if crude prices continue to remain at the levels they are right now, then it might be difficult for the country to achieve over 8% growth in the current financial year. So those kind of warnings have already started coming in. So we'll have to wait for two more numbers from the RBI governor. One, the growth outlook, and second, the inflation outlook. Concerns clearly the RBI governor, Mr. Shaktikanta Das, has already raised that if the existing situation continues like this, it's not going to be a good news for us, because our domestic inflation has started going up already.
Right, Hina, thank you so much for actually giving us a comprehensive assessment of the situation at the moment and the reasons why as to how the RBI chief has now decided that after the monetary policy meeting that the key rates, the bank rates and the repo rates will remain unchanged. Hina there bringing us an update on that. Thank you so much for joining us. Right, more breaking update coming in, and the reverse repo rate has been hiked by the RBI to 3.75% from the current 3.5%. So there's at least one change that we can see, that the RBI chief has just announced, that the key rates, the repo rate and bank rates have been unchanged, but reverse repo rate has been hiked. So just to sum up for our viewers, just a short while back, Shaktikanta Das, the RBI chief there, essentially saying that the RBI is going to keep the repo rate and the bank rate unchanged, but the reverse repo rate has been hiked, and the hike that we can see, which has been announced, is to 3.75%. And earlier it was 3.5%. Shifting tracks now, in Mumbai, commuters continue to suffer as centre and the state bicker. A fresh flashpoint has emerged between centre and Maharashtra government over a Mumbai metro project. Central government has written to Maharashtra once again to reconsider their decision to move the Mumbai metro car shed from RA to Kanjurmarg. Centre cited several technical issues as their reason, but remember that this has been a fight which has been going on constantly, that there has in fact been a constant tiff which we have seen between Maharashtra government and the centre over this particular metro project.
At US dollar 100 per barrel, 100 per barrel, inflation is now projected at 5.7%. I repeat, inflation is now projected at 5.7% in 2022-23, with Q1 at 6.3%, Q2 at 5%, Q3 at 5.4%, and Q4 at 5.1%. It may, however, be noted that given the excessive volatility in global crude oil prices since late February, and the extreme uncertainty over the evolving geopolitical tensions, any projection of growth and inflation is fraught with risk and is largely contingent upon future oil and commodity price developments. In this context, continuation and deepening of supply-side measures may alleviate food price pressures and also mitigate cost push pressures across manufacturing and services. On our part, let me assure all stakeholders that, as in the past, the Reserve Bank will use all its policy levers to preserve macroeconomic stability and enhance the resilience of our economy. The situation is dynamic and fast-changing, and our actions have to be tailored accordingly. I would now like to turn to liquidity and financial market conditions. As stated earlier, the macroeconomic outlook is undergoing tectonic shifts, and our policy response has to be preemptive and recalibrated dynamically to the evolving outlook. The Reserve Bank will continue to adopt a nuanced and nimble-footed approach to liquidity management while maintaining adequate liquidity in the system. Let me again read this statement because it's very important and the communication should be very clear to the market. The Reserve Bank will continue to adopt a nuanced and nimble-footed approach to liquidity management while maintaining adequate liquidity in the system. At present, liquidity management is characterized by two-way operations through variable rate reverse repo auctions, that is VRRR auctions, of varying maturities to absorb liquidity, and variable rate repo auctions, that is VRR auctions, variable rate repo auctions to meet transient liquidity shortages and offset mismatches. This approach will be continued. It may be noted that the interest rate for around 80% of 80%, 80% of the liquidity absorbed under the LAF during the fourth quarter of 21-22 has firmed up close to the policy repo rate due to the rebalancing of liquidity through our VRRR auctions. Accordingly, financial participants and financial markets have been prepared for the eventual normalization of the LAF corridor, which we are doing today. So therefore, the normalization of the LAF corridor should not come as a surprise to the market, because we have prepared the market over the last several months, whereby the 80% of the liquidity is being absorbed at a rate close to the repo rate. Further, it has now been decided to fully restore the liquidity management framework instituted in February 2020, albeit with some refinements to enhance its effectiveness. Accordingly, the following measures are being instituted. 1. The amendment to Section 17 of the RBI Act in 2018 empowered the Reserve Bank to introduce the Standing Deposit Facility, that is SDF. By removing the binding collateral constraint on the central bank, the SDF strengthens the operating framework of monetary policy. Accordingly, it has now been decided to introduce SDF as the floor of the LAF corridor. This would provide symmetry to the operating framework of monetary policy by introducing a standing absorption facility at the bottom of the LAF corridor, similar to the standing injection tool at the upper end of the corridor, namely the marginal standing facility. Thus, at both ends of the LAF corridor, you see both ends currently after we have introduced SDF at 3.75. Currently, the LAF corridor, therefore, the 50 basis points corridor is 3.75% SDF at the lower end of the corridor and 4.25% at the upper end of the corridor through the instrumentality of the MSF. So thus, at both ends of the LAF corridor, there will be standing facilities, one to absorb the liquidity and the other one to inject liquidity. SDF absorbs liquidity, MSF would inject liquidity, and this will depend on the evolving financial market conditions. It can vary from day to day also. Accordingly, access, and further, this is very important to note, that access to SDF and MSF will be at the discretion of the banks, because they are standing facilities. They will be at the discretion of the banks, unlike repo, reverse repo, OMO and CRR, which are available at the discretion of the Reserve Bank. So the standing facilities give the discretion to the banks. And the other tools I mentioned, the OMO, the reverse repo, or the CRR actions, if any, they are at the discretion of the Reserve Bank. Notably, and this is very important to note, that SDF is also a financial stability tool in addition to its role in liquidity management. So the introduction of SDF is for twin objective of doing proper and appropriate liquidity management in the current context, and also to further strengthen, financial stability. So it has two broad objectives. The second point, I mentioned that there are, we are instituting several measures. The first one I have said. The second point is as follows. The SDF rate will be 25 basis points below the policy rate, and it will be applicable to overnight deposits at this stage.
Shaktikanta Das there, the RBI governor, making key announcements as far as the economy is concerned. In fact, some of the main points that he raised, he said that the inflation is projected at the moment at 5.7%. As far as the financial year of 22-23 is concerned, growth projections assume crude oil is still at $100 per barrel. Macro outlook is under tectonic shifts, and the real GDP growth seen at 7.2% in FY23 versus 7.8% projected earlier.